One of the great advantages of the FastGraphs Fundamentals Analyzer software tool is the ability to see how the price has performed over the long run in relationship to how the business has performed. With normal stock charts, are so common, you don't get that perspective. You see the price, but you do not have the perspective of how the business does. And in the case of the BDC Prospect Capital, you can see that the business's earnings have actually been dropping year after year, and note how the stock price has followed that. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. Unfortunately, I'm a day late on my subscriber request Tuesday video, so I'm doing it on Wednesday today, but I was requested by subscriber Stoyan Minev to look at BDCs, business development companies. And I did cover business development companies in a previous video, and I've got a link at the bottom of this video. Basically, you can review that video as well. I did that one in April of last year. So you've got a nice perspective on what's been going on with BDCs. Now, let's go ahead and get into the FastGraphs and let me talk about what I'm doing here. I've put together a list of 9 BDCs, but one thing I want to point out is only a handful of business development companies even have credit ratings. But maybe the best way to start out with this video is talk about what a business development company is. It's actually a closed-end investment company that helps small businesses grow their capital and grow their businesses by either lending them money or taking equity positions, but they do a lot of lending. Okay, they make investments in companies of smaller size. That's one of the things that differs them from the average venture capital firm. The tax structure of a BDC is that they're treated as regulated investment companies for tax purpose, which simply means that they must distribute 90% of their taxable income, and then they are not taxed at the corporate level. However, the shareholder, the investor, is taxed at their level based on ordinary income. So you want to basically remember that you are looking at some tax situations here when you invest in BDCs, and your ordinary income is really what's going to determine that. The point that I want to make here is that, and I titled this video, these are high-yielding investments, but they're also considered high risk. And I'm going to go over those risks very quickly with you in this video today. But I do want you to notice one thing is very few of them even have a credit rating, and very few of them have a credit rating that's just only slightly, initially investment grade or just at the lowest rung of investment grade, if you will. Now, one advantage of investing in business development companies, you can see the 9 that I'm covering here in this video today, are that they have extremely high yields, even as high as 16.71%. So statistically, they can look very, very attractive. They also, I always talk about wanting to see a 6.5% to 7% earnings yield as a minimum. And you'll notice that all of these meet that criteria. They all have earnings yields that are high. But one thing that often goes unsaid when I'm talking about things like earnings yields are that earnings yields are relative to the future. So you want to look at an earnings yield that's low today, but a company that's growing their earnings so that their earnings yields, their growth yield, I like to call it, or their earnings yield is very similar to yield on cost on dividends. It would be the earnings yield on cost would be expected to increase over time as the company's earnings grew. Okay, that would be the traditional company, but BDCs are quite different in that regard. So I'm going to go through these, and I'm going to do it as I like to do to keep track, because oftentimes I miss stocks and I get chastised by y'all for doing that. I'm going to do them in alphabetical order because I want you just to see some of the characteristics of these BDCs. Now, they must distribute at least 90% of their income. And the BDCs themselves were formed by Congress, by the act of Congress. And it was the closed-end fund advisors, May 2019, pointed out that there are about 49 BDCs. Now, I actually have a portfolio where I have about 42 BDCs listed. You can search for them if you're a FastGraph subscriber. You can look for the subsector asset management companies. So they're all under financials, but you can also look for asset management companies, and you can find a list of the most prominent BDCs. But the thing is, they invest in private companies and mostly small firms. They kind of fill a niche that venture capital oftentimes overlooks. One of the problems or the key takeaways with BDCs is that they are publicly traded and they are open to retail investors. That differentiates them from a lot of private equity firms or venture capital firms. They do offer high dividend yields, and some actually give you some capital appreciation potential, but some don't. And I'm going to cover that here throughout this. And as I show you these 9 examples, they use a lot of leverage, which is what gives them the ability to have these high yields, but it also makes them relatively risky. And, one of the concerns that a lot of people have about BDCs, and I am going to admit I'm not an expert in this regard, the BDC track records I'm going to be showing you have all existed during this, tremendous drop in interest rates. But theoretically, spikes in interest rates can be deleterious to BDCs as well, because it means that the cost of borrowing, and they rely heavily on leverage, is going to go up. But to qualify as a BDC, a company must be registered in compliance with Section 54 of the Investment Company Act of 1940. It must be a domestic company and whose securities are registered with the SEC. Okay, so they're very similar to REITs in that regard. They do have their own, characteristics that differentiate them from the average C company you would look at. Okay, because they're regulated, they must distribute 90% of their profits. And again, that means they don't pay corporate income taxes on the profits before they distribute them. Therefore, shareholders, bear the whole weight of all the distributions. And I like to call them distributions rather than dividends, because that's really what they are. So let's go through these 9. These were actually at the bottom of the video here. I put the quote that Stoyan asked me to cover BDCs about, and he asked me for some specific ones. And I've covered each of them, but I've also added a few of the more prominent ones for your clarity and understanding in terms of what this is all, what BDCs are all about. So I'm going to go through them, but I'm going to go through them in alphabetic order. So let's look first at Apollo Investment, and I'm going to do this with operating earnings. And Apollo Investment is one of the most prominent of the BDCs. And I want you to notice some things that are really interesting about this. From a standpoint of operating earnings, I want you to note that in many years earlier, they were actually paying out far in excess of 100% of their actual operating profit. Okay, but now another way to look at this would be to look at something like EBIT, which is operating margin, and you can again see that they have payout ratios that exceed that. And then if we look at EBITDA, earnings before interest, taxes, and depreciation, we once again see some very shaky looking numbers here. From a standpoint of operating cash flow, we also run into that. This is what I mean by high risk. These companies tend to dilute shareholders. They tend to, as I covered in the other video last year, you can take a look at that. So when you're looking at these guys, and as I said in the introduction here, you can see the relationship of the company's operating results to the company's performance. And here's what I want you to note. With Apollo Investment Group, if you put $10,000 in this stock, almost 17 years ago, 16.9 years ago, your dividends, you'd have gotten 100% of your money back through dividends, where you would only got half of it back through the S&P. But your investment would have actually shrunk from $10,000 to $2,630. And that's an annualized loss, if you will, capital loss of 7.58%. Now, you add in the dividends, you do get a positive rate of return of about 1.6%, but you dramatically underperform the market. So, as I said in the title, these high yield, high risk, or both. And I would consider them, high risk, because you actually have capital depreciation. You got a lot of income, but very little capital appreciation. Arris Capital is one of the better BDCs, one of the higher rated BDCs, and it does have a market cap of $9.8 billion. What I like about this particular BDC compared to a lot of the ones that I look at is that they've had pretty much flat earnings growth. Though we have an anomaly here, so I'm going to scroll that out so that you get a more realistic look at their growth. Has only been about 2.4%, but they have stayed relatively stable. Consequently, in contrast to what we saw previously, when I look at performance here, the $10,000 actually grew slightly to $12,794. They paid $16,000 plus in dividends, and so they gave you an average rate of return of about 6.8% compared to the S&P over the same time frame that would have given you 9%. But what they do produce, they produce an 8.17% dividend. And again, the dividend is not always being covered by the company's earnings. So that's another issue with these BDCs. The next one we're going to look at here is Great Elm. And once again, we see collapsing earnings over all these years. when you're looking at a 16.71% dividend yield, or distribution yield, which is obviously looks very attractive. You're looking at a 19% earnings yield. But when you look at historical performance, $10,000 would have shrunk to under $1,000. Okay, that's a 22% annual loss. The company did pay, twice as much dividends of the S&P, but you still ended up with a net loss holding this stock, over this time frame, which is almost 11 years here. You would have actually lost money. So the high yield can also be high risk, as I indicated with some of these, in the title. Horizon Technology is another one that has a pretty decent growth rate, actually, compared to most BDCs, I want you to note. But again, you can see that the price correlates to the company's, fundamental, operating results. I'm going to shorten this again because I got a dividend spike there. You're looking at less than 1% growth during this period of time. So if we measure performance over this period of time, we almost broke even with Horizon. And that's for 9.2 years here. We did get a substantial amount of dividends, 8,918 versus only 3,000 during the same time frame for the S&P. But you ended up with half of the total rate of return of the S&P because you actually lost about 0.15% a year in capital depreciation, if you will. So once again, the BDCs can be misleading in terms of what they actually offer shareholders. They can be high yielding. Now, Main Street is one of the better known names in this space as well. It's got probably about the highest growth of any. It was one I also covered in the other video. It has almost 9% growth historically. As a result, we do see a company here that almost matched the S&P tit for tat as far as growth is concerned. The numbers were very, very comparable, 7.7% versus 8%. But they did throw off $20,000 in dividends versus the S&P. So you got almost a 12% rate of return versus 9%. So this is, as I always like to say, it's a market of stocks, not a stock market. So even in the BDC space, there's quite a bit of difference in the different companies. And this one was actually overvalued last April when I did the original video. And you can see that it kind of, looking at it now a year later almost, it went sideways, but it's now come into value. So this could actually be one that might be moderately attractive. But I do want to remind you again that rising interest rates could be problematic for these companies. So that's something to take into consideration. Monroe Capital is another one. I want to shorten the time frame and get rid of some of this anomalous growth. It has negative growth, but it's modestly negative compared to some of the ones I showed you here today. But once again, you have capital depreciation. 10,000 shrunk to 7,400. Did pay 7,000 in dividends. So you got a positive rate of return of 5.46%, but you underperformed the overall market, although you did get 5 or 6 times as much income, and that would be the allure. This one's yielding 9.3%, has an earnings yield of 9.76%. And, it might theoretically be trading at a premium because it normally trades at around an 8.4 times earnings, and it's trading at about 10.45. And, so again, these are different animals than we're dealing with when we're looking at normal, regular companies. Now, this one is quite interesting. I found New Tech Business Development. They went through a period of significant losses here, but since 2012, they've actually done pretty well. You can see that their earnings growth, well, let me shorten that 2 more years for you. Their earnings growth has been about 11%. So looking at them over this time frame, the company yields 12.35%, has an earnings yield over 12%, and it has historical performance that has been decent compared to the S&P 500, other than the fact that their dividend income was dramatically higher. It allowed them to essentially tie or even just slightly outperform the S&P over this time frame. But it did generate, if you're an income investor, significantly more dividend income. So that would be something to consider when you're looking at that one. And then I've got Owl Creek here, which is one of the newer, BDCs. It's only been trading publicly for a couple of years. It seems to be holding up earnings growth reasonably well, but not great. From a performance point of view, it only lost about 2,000 of your 10,000, but it does produce a lot more dividend income than the market. But the rate of return, the total rate of return is actually anemic. It does offer an 8.64% yield, earnings yield of 8.83. These are, the question was, are these high yield, high risk, or both? And I think both probably really foots the bill for these companies. They are difficult. Then here's Prospect Capital, which I covered in the beginning. And again, one of the better known BDCs. And you can see that the earnings growth, I'm going to kind of get rid of a couple of these growth years in here. So I'm going to drop that down to a 15-year graph. They've actually had negative earnings growth. And you look at their long-term performance, they generated a bucket load of dividend income, $12,000 versus only $4,000 in the S&P with an equal investment. But again, their $10,000 investment would have shrunk to $6,000 compared to investing it in the S&P that went to $34,000. Net result, you lost 3.6% a year annualized in capital loss, and you ended up with a 4.48% total rate of return. That's assuming now that you add up the dividends. Anyway, this has been Chuck Carnevale, also known as Mr. Valuation, providing you another subscriber request, kind of taking a look at BDCs. Not an area that I'm really proficiently knowledgeable in, but it's an area that I've avoided getting any knowledge in because I don't like the basic functions of these BDCs long term. They entice you with high yields, but they also bring high risk. If you like this video, please give me a like, ring the bell, subscribe to the channel if you haven't already. And again, take a look at the video I did last year to give you some additional perspective in how BDCs work. Thanks for watching.